Most people are sleeping on one of the biggest shifts in finance of our era. And I'm talking about the rise of stablecoins and what they mean for the US dollar and what they mean for gold. And so today, I'm sitting down with Andy Schectman to break down why stablecoins might just be the sleeper revolution in global trade and what that means for the future of the United States empire. Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance so that we can better understand the world. Here is Andy Schectman. Enjoy.
This is Jay Martin.
All right, here I am. Andy, great to have you back in the show, man.
Yeah, Jay, it's good to be here, buddy. Nice to see you. Thanks for the invite.
Of course. So there's a handful of different directions I want to go with you today, and here's where I want to start. There's maybe two main topics I want to break down with you today.
Sure.
And the first is the Genius Act and stablecoins and what this means, what they're for, who owns them, and why. And I really want to break this down for the audience so they can clearly understand the use case and the intention behind this Genius Act. And then I feel like this is kind of a juxtaposition. We'll get into that, but why the Genius Act might be a complete juxtaposition against what people are calling the debasement trade, which frankly I think is a misnomer. You probably do too. There's nothing about this that strikes me as a trade, but nonetheless, people call it what they call it. So that's where I want to focus today. Let's start with the Genius Act, Andy, stablecoins. What do people need to know? Let's start there, and then I'll pull on some threads.
Yeah, absolutely. And I actually think debasing the dollar is something that I could see them wanting to do. And I think, in fact, I think they do want to do it for various reasons. And I do think that the Stablecoin Act, the Genius Act, is part and parcel to it. So let me try and break it down for you.
Okay.
When I talk about the Genius Act, to me, I would say one phrase comes to mind, and that would be synthetic demand. So in mid-2025, as people probably know by now, the U.S. passed the Genius Act formally, and it legitimized fully backing privately issued stablecoins. And I guess its real impact is that every new dollar of stablecoin demand becomes a new dollar of Treasury demand. In other words, when dollars are created in any form and they move throughout the ecosystem, they have to be backed by or connected to stablecoins. So the concept of checks and wires will be gone. Your money will transfer like that across a blockchain network, similar to Venmo, similar to Zelle, only it will be connected to all money. And so when you talk about, and there'll be short-term treasuries. So first and foremost, what you are doing is you are creating synthetic demand for the short-term treasury, or call it financing even for short-term treasuries. Now, the interesting thing about it is that the interest that comes from the treasuries that backs the movement of currency, whether you're buying a pack of bubble gum at the gas station or paying for your kids' college tuition or buying a new home, all of it is going to be moving via stablecoin, which is backed by treasuries. The interest on those treasuries is not transferable. So that's first and foremost, but it's going to push down interest rates on the front end of the curve synthetically. It is going to, in essence, fund a growing share of the United States deficits, and without any direction from the Fed. This is going to be done just by the movement of money. But what's interesting about it is that that interest isn't transferable. Companies like USA Tether, whose CEO is a man named Bo Hines, who was Trump's crypto czar through August. And now he's benefiting from the rules that he helped implement. And what you're seeing with a company like Tether, what they're doing with all of this profit that they're earning from issuing treasuries, backing the movement of stablecoins, is they're buying commodities, in particular gold. Over 13 billion, I believe, at last tally, of gold that they're buying, which would debase the dollar. The more gold that you accumulate, the higher the price of gold goes, the the lower the value of the dollar goes. It's a way to devalue the dollar. That's what Roosevelt did in 1933 when he confiscated gold at $20 and then devalued the dollar by 40%, making gold $35 an ounce. So in essence, what they've been doing, and I believe what the plan is, and it's part of a bigger plan, and I guess I'll just connect all of the dots and then you can pull any string you want. My belief is this is what they're trying to do on the surface. Look, they want to bring back manufacturing. How do you do that? Triffin's dilemma is the economic theory that says as the world reserve currency, you can't do it because the world needs more dollars than we can provide them through trade alone. And so they, in essence, currencies over time, countries over time have to sell their currency to buy ours. It weakens theirs, strengthens ours. And over time, the continual purchasing of our currency or our exporting of dollars creates an imbalance where those currencies are so much cheaper than ours in relation that manufacturing naturally flows to the countries where it's less money to produce. And so you hollow out your manufacturing. You can go back to the previous administration, the knucklehead Jared Bernstein. He was a knucklehead. If any of you have watched him try to explain the issuance of treasuries, it's truly humiliating. But what I will say is that he did write a report called Dethrone King Dollar, which advocates for this, that we can't be the reserve currency anymore. It is too much of a drag on manufacturing. The vice president of the United States currently, Vance, said the same thing on White House letterhead, that the world reserve status, because of Triffin's dilemma, has been a boon for the consumers. Low interest rates, cheap goods, high asset prices, but it's been too much of a drag on the manufacturing base of the country. A country where 60% of its population currently has a literacy rate under that of the sixth grade. No formal education after high school, if that, and a sixth grade literacy rate for 60% of the country. A country that's 38 trillion in debt, with the last trillion in debt happening in 71 days, but that excludes the 175 plus million in unfunded liabilities, Medicare and Medicaid, Social Security, military and government pensions. A country that is in essence broke, insolvent, has no manufacturing base, and AI is going to chip away at many of the entry-level jobs. 50% is the current estimate within a half a dozen years or less. If we don't bring back manufacturing, we're dead. So how do they do it? Step number one, reshore all the gold and silver, as we've been seeing huge amounts. They say it's tariffs. No, it's not. I've been screaming that for 8 months, 9 months. It's reshoring. Step number two, create the Genius Act. The Genius Act creates synthetic demand for the U.S. Treasury and helps fund all of our deficit spending in a world where the treasuries aren't as sought after anymore as they once were because of weaponization, because of fiscal irresponsibility, creating $1 trillion in 71 days. Let's not forget how big a trillion is. 1 trillion seconds ago was 31,688 years ago. So you have this vehicle called the Genius Act, which is diabolically genius that anytime money moves, and it's not a CBDC, central bank, it is created by private institutions that are governed by the Genius Act legislation. So the feds will control the on-ramp and the off-ramp, similar to a CBDC in scope. But what it really does is create synthetic demand for the short-term treasury, pushing down interest rates. The key to it is that the interest rate is not transferable. So what are they doing? They were at Beaver Creek Mining Summit. They have $13 billion in gold. They have 10 or 12 billion in Bitcoin. I believe they will use gold, the continual accumulation of gold, to help devalue the dollar. And I believe personally that they will use Bitcoin in an effort to pay down the debt, which could mean that you see an occasional rug pull, maybe, maybe not. But what I do believe is that they will use it for that reason. This is my own personal belief, right, wrong, or indifferent. That's one half of it. What about the back end of the bond market? Well, Judy Shelton has been on my podcast twice, once with me about 7 months ago, once with Michelle McCory last month. In it, she says, Andy, in no uncertain terms, Trump has told me, when I was part of the transition team, that he will peg gold to the back end of the bond market on July 4th, 2026. She says this, and she sticks to it. It's in her book. And she says he will do that, and that's the 250th anniversary of the country. He will do that to reestablish credibility. So how do you bring back manufacturing? Well, we got the front end of the curve handled. We know everyone keeps talking about devaluing or revaluing gold and devaluing the dollar. James Rickards is saying 24,000 for gold. Mike Maloney says 10,000. Pick your number. The higher the price of gold goes, the more devalued the dollar gets, which helps sell manufacturing to the globe. But how do you get your manufacturing back? Well, Judy's right, and you have treasuries. She says starting at 50, may not have as much demand. She said maybe a 1% interest on the 50-year treasury at most, redeemable in gold. But in her book, she says 5, 10, 20, 30-year treasuries, redeemable in gold, zero coupon. And she says maybe they'll issue stablecoins off of those treasuries too, is what her belief is. But if you have treasuries that are redeemable in gold that have no upfront borrowing costs because there's no coupon, you can bring back your manufacturing at zero upfront borrowing costs and let gold rise, maybe revalue it at some point to sell your products in a massively devalued dollar. In other words, what I'm getting at is that I do believe that they want to lose the reserve status in order to defend the bond market, in order to bring back manufacturing, because any way you look at it, if we don't bring back manufacturing, we're broke, we have a country that's uneducated, we don't make anything, and AI is killing many of the jobs. So what do you do? What do you do? How do your children and your grandchildren survive in a world where we are reliant on everyone else in order to manufacturing things, and nobody wants our treasuries anymore because we have chosen, as you can see, we have chosen inflation long before we will ever deal with austerity. So I know that's a lot to unpack, and I'm sorry for going down that big road, but I think they're all connected. And in order to understand the Genius Act, in my mind, I think you have to look at potentially all of the other things that could happen in conjunction with it. And I fully recognize I'm pretty much the only one saying this, but it's something that I see as an option. In other words, Richard Russell always used to say the Fed is trapped. They can inflate or die, inflate or default. This is option 3, soft default on the reserve status in order to bring back manufacturing by creating demand, both synthetic and real, for the Treasury, short-term and long-term.
No, and thank you for taking us on that journey, because I want to unpack a couple steps of it now. But just to recap a couple things, the purpose of a stablecoin is that, Tether, USDC, Binance, USD, these are the primary biggest issuers, it seems like. And people use them for just like frictionless cash transactions. You want to send money to your family back in Hong Kong, somewhere cross-border, it's a lot easier to use a stable coin than a dollar of anything.
Correct.
It seems like a lot of the use is just people need a settlement currency for when they're trading cryptos as well. But the point is, it's a global consumer base that now is purchasing an asset that supports the US dollar. And so we're kind of like digitally dollarizing little pockets of the global economy as a consequence. But the bigger piece, as you mentioned, is that these issuers, Tether, USDC, Binance, et cetera, have to hold US dollars on a one-to-one basis to stablecoins. They do that by purchasing short-term treasuries, adding a new buyer to the marketplace, which the Fed desperately needs. And what do you mean, though, Andy, when you say the interest rate is not transferable? What exactly does that mean?
So when Tether uses the stablecoins to back the movement of money, the interest you can't give to the stablecoin holders. So they keep the interest. And so with that interest, they're buying gold and they're buying Bitcoin. You can see it on their balance sheet.
That's the $13 billion in gold that Tether's acquired, because they generate the interest from but they don't pass that on to the stablecoin holders. So it's great business for them. Okay. That's really interesting. And
if you look at Bo Hines as the CEO, who was Trump's lackey, Bobo, a wink, wink, nod, nod. You're going to buy gold and you're going to buy lots of it to devalue the dollar. You're going to buy Bitcoin to help us pay down the debt. I mean, there's no coincidence that they're buying these two assets. Mm-hmm. And they would benefit a weakened dollar if you are really trying to bring back manufacturing. You must have a debased currency. You must. That's what all the other currencies have done to make their exports attractive. That's what I think they know they need to do here too. And this is how they're doing it.
Well, that's really interesting, because the big Achilles heel that I've seen in the reshoring conversation, everybody talks about bring back American jobs, reshore manufacturing of key industries, and the headline makes intuitive sense. You're like, of course, this is in our best interest. Let's do that. But we have a pretty recent case study of what that actually looks like, and that's China over the last 30 years. And it cost them about $40 trillion to build that manufacturing hub that they did, the specialized economic zones with the refineries built right beside the component makers, right beside the deep water ports or the heavy rail, like, very specific economic design to maximize the efficiency of manufacturing and reduce costs. But it still cost them about $41 trillion to do that. That was over the last 30 years. The US wants to reshore industries in today's dollars, right? And from my perspective, I'd love to know your take on this, with a headwind. Like, we all wanted China to industrialize because we all benefited from the increased access to a wider variety of cheaper goods, right? That's what happened. So it was in the global economy's best interest for China to industrialize. It's not for the United States to industrialize. It's in the United States' best interest, but there's no global tailwind supporting this. So there's additional friction, tremendous increased cost, and it seems to me the only way this could be accomplished is through incredible money printing to finance this reshoring effort that would create an inflationary wave, the likes of which we've never experienced before. It would dwarf anything we've seen in the past. What's your take on that, Andy? And I guess that's how this piece fits in. This is the strategy to get around that outcome.
Yeah,
Is that
I agree
right?
with it. I think the drawback, the side effect would be universal basic income for a while. I do. And I think the selling piece is, look, we screwed up a good deal. The world has been our creditor. We've had low-priced goods. The recycling of their money into treasuries has given us low interest rates and high asset prices. But the problem is the rubber is meeting the road right now. Foreigners used to load up on U.S. treasuries back when America looked stable and risk-free, but not anymore. And with $38 trillion in debt before unfunded liabilities, with $500 billion added in just the last 6 weeks, foreign governments are losing faith. They're dumping dollars. They're diversifying into gold at record pace. And that's the point. Record U.S. debt is driving record gold demand. It's driving people out of the treasuries. And until Washington gets really serious about fiscal discipline, this won't stop, and they're not going to. So I think this is the path, is that you must bring back manufacturing at all costs, no matter what. If you don't, our future generations are in serious, serious trouble. And AI is taking away and robotics and automation. That'll take place a lot of the jobs they bring back in manufacturing, but we still must do this. If not, you can't be reliant on pharmaceuticals, from aspirin to penicillin, on machine parts, on aircraft parts, on military components. You can't be reliant upon what in essence is almost our foes across the globe to provide this to this country, especially when we are as indebted as we are. And we can't expect that countries will want to continue to take our treasuries when we are as fiscally irresponsible as we are. So this provides synthetic demand. And on the back end, the gold says, okay, fine, we don't want your dollars. And the more stupid you are with fiscal irresponsibility, the higher the price of gold will go. That is the interest rate that they tag on to the back end of the long bond, because it will be denominated and redeemable in gold. So there is no perfect answer, but it's like Andy Dufresne in the Shawshank Redemption. He had to crawl through 2 miles of crap to get to the other end. And when he got to the other end, he stood like this and he made it. Well, there is hope at the other end. And I think no matter what, we have to find a way to bring back manufacturing. To me, this is the only way, really, while you still can find demand for your treasuries, both synthetic and real.
You pointed out a couple things there. One point you made was how many of the jobs we reshore will be made redundant by AI and robotics technologies, right? And as the United States is sporadically trying to reshore these jobs, China now employs more robots in the workforce than the rest of the world combined. And in 2024, they added another 300,000 robots to the labor force. The United States added 34,000 for comparison. So, a tenfold increase in robotic labor to the Chinese manufacturing base while we're trying to bring back human jobs to the West. It strikes me as a bit like too little too late. And I hope I'm wrong. You also mentioned pharmaceuticals. And I think this is maybe, it's underserved from a media standpoint, but this is maybe the next big lever. Everybody talks about rare earths and magnets and advanced tech and weaponry. This is the big lever that China has. Well, pharmaceuticals are the other one. And maybe that's the next inning in the trade war. If I was sitting in Beijing. That's a ace up the sleeve that they haven't really pulled yet, that I think would catch just as many Americans off guard as the rare earth conversation did. Len, let me ask you, if you have any comments on that, I'd love to hear them.
Look at
first
all
of
the
all.
companies that are selling emergency pharmaceutical packs because just in case you can't get it. Well, that's
Right.
a reality. It's all the same reality as buying freeze dried food. And during the pandemic, we couldn't get running out of things like insulin and penicillin, all the things that you need. You can't do that. We have, in essence, hollowed out our entire manufacturing base, and one way or the other, I think it does need to come back. Now, and to your point, it may be too little too late, or certainly in an effort to get people working again, lots of people, but I think you have to bring back manufacturing even more so than you have to bring back the jobs. If we don't, this country is at a serious I think a serious place in history where the rest of the world, who is moving away from the dollar, has us compromised, if you will, to a large degree moving forward.
We've seen in the last 8-10 weeks, almost every single week, a new $1 billion deal between either the government or a department of the government and private enterprise, right? And the majority of which have been in the extraction industries. These aren't loans or subsidies. These are equity financings, right? Like a 15% stake now in MP Materials. Department of Defense is the largest shareholder. 5% in U.S. antimony, 10% in Lithium Americas, 10% in Trilogy Metals up in Alaska, that asset. These are all part of the sort of critical metals stockpiling effort, right? It struck me as like, this is interesting. It's like the issuer of the currency is now adopting my investment strategy. They're trading fiat currency for hard assets, right? And one deal after the next. It was Rare Elements and Volcan last week for a rare earth refinery and magnet manufacturer. What's your take on that, Andy? Do you call it state capitalism? Do you think this is a new trajectory? What's your take on this?
Yeah, I do. I mean, I think they have gone from doing everything they can to delegitimize gold and silver to making it far more in-your-face overt. Of course, you know that the U.S. just reclassified silver as a critical mineral, amongst many others. And the amount of gold and silver that have been brought into the COMEX since last November is off the charts. And, somewhere in the neighborhood of 200 million. But there are reports that just came out in the Financial Times that said that governments around the world are reporting roughly 1/3 of their official buying, down from about 90% 4 years ago. That's according to the World Gold Council. And then China, which is the world's largest producer and consumer of gold and the second largest of silver, certainly not being transparent how much they own. 10 times, they assume, more than what they are reporting. And they're also, they just came out and said they're going to limit exports. They're going to tighten silver exports. This is a race, if you will, to accumulate physical metal. And I think the government understands that, not just physical metal, all critical elements. And I think it's no longer about promises from a broke country, in other words, taking our treasuries, and more about who's got the real stuff. You can see this in the amount of deliveries coming off of all of the world's exchanges. You can see this in how the people that are importing hundreds of billions of dollars of metal into the United States are the most, not just the most well-funded traders here in North America, if not the world. They're the most well-informed. But that goes hand in hand with what the central banks have been doing. The first podcast I did with you years ago, that was probably front and center what we talked about, how the central banks have been buying gold. Here you have and silver and other commodities, that you have the most well-informed traders in the world showing you what they are doing. And it's gotten to the point now where there's no reason hiding it any longer. And in particular, if you do want to debase or devalue the dollar, you do it in raising the price of all of the world's commodities, because we've become too accustomed to measuring the currency against a basket of crap currencies, the dollar index. It's not how you should do it. Dollar is down 8 or 9% against the dollar index, mostly the euro, but it's down 70% against silver, 65 or so percent against gold. And so I think it's come to the point where perhaps they do want to debase the currency. Even mainstream media is talking about it now, that it's not a hidden agenda. To me, what they aren't talking about, everyone says it's to pay down the debt. To me, it's bigger than that. It's to be able to have an inkling of a chance to start to sell your manufacturing to the globe. It would be one of the first steps. Now, you could argue that it's premature to do it before you bring your manufacturing back, but I don't know if there is a plan or a strategy on how you do this. It seems to me that the best way to do it will be to let gold and silver move up organically for a while and then maybe revalue it at some point. But I do think that's what they're doing, and they're in your face with it now by taking these positions in companies like this. There's no question about it. I think you'll see more and more of it. It's never really a great deal when you have the government in private enterprise, but I do think it goes to show the desperation of a country that realizes that these items are critical, and we are way behind the eight ball in accumulating them, in refining them. It's not just the accumulation. China is responsible for the refining of 90+% of all the world's rare earths. So it's not just in pulling it out of the ground, it's refining it. And it's interesting. You look at a country like China, which is the second largest producer of silver in the world. They tell David Morgan when he went there, no, we're number one. They're either one or two. They're arguably number one in gold. Now, you talk to Sean Kunkun, who you know, the CEO of Dolly Varden, and he'll say to you, stupid cord, he'll say to you, yeah, Andy, China is flying all around South America, in particular Peru. You mentioned deep water ports. China just built a deep water port there. The Belt Road Initiative is building things like deep water ports, rails, maritime channels, bridges, gold and silver mines, oil refinery. They're building it all within this ecosystem and then helping get it to market. Well, they're going to Peru and to Mexico, buying it in doré and concentrate form before it's even called silver or gold, and shipping it back to China where they refine it themselves. There is a rush to get the stuff. And thank God, in my opinion, somebody got to Trump, because all of this started in terms of importing into the U.S. somewhere around November of last year when he won the election. There is no question in my mind that someone got to him and said, we are losing the race. The last administration really put us behind the eight ball. We need to do this right now. And I think that's what this is all about. So to your point, yes, it's not really normal. It's somewhat surprising at first glance, but to me, it really isn't. And I think it's a necessity.
That's interesting. And I'm with you on that completely. I talk about this, call it state capitalism, or the marriage of, public-private partnership that we're not so accustomed to in the West. Like, it's more of a foreign concept here, but this is status quo, Chinese business, right? This was the marriage of socialist and capitalist policy. Now, we're not nearly there. Like, let's not get out of hand here, but I talk about it on the show, and often people are like, why are you supporting state capitalism? And I'm like, I'm observing. It's happening. No one cares what I think about it. This is a trend that's unfolding in real time. And to your point, I think the administration's woken up and realized that they can't wait for the free market to catch up. They need to force an outcome, or at least try. And that's what they're doing, and I believe will continue to do. And
it's interesting, by the way, too, Tether has taken stakes in other parts of the gold supply chain, including royalty companies. So much like the government, you got Tether with a $180 billion balance sheet in reserve assets. They're hoards of gold, some of the world's biggest outside of banks and nation states. They're doing the same thing the government is doing. Now, you have to wonder, is there any coordination here? Bo Hines, Trump? I don't know. I'm just saying, to me, there is.
Okay. I like that. And okay, you mentioned coordination. It kind of flags something in my brain. I want to move on to a different coordination between the Treasury and the Fed, if you think there is one. And, what's the true modern independence of the Fed today from your standpoint, Andy? And I'd love to get into, I know you're watching the short-term Treasury market and these kind of like QE, not QE efforts. by the Fed to fund the repo market. I'd love to break this down, what's going on there, what it means, and what are you watching?
Well, first of all, I would argue that there is basically no independence with the Fed, none. I mean, it's funny too because Goldman Sachs says, if the market fears that the Fed has lost independence, you'll see gold at $5,000 very quickly. Well, when you have the architect of the Mar-a-Lago Accord, Stephen Meyer, and fill one of the vacated spots at the Fed, who was Trump's advisor, what independence? There is no independence. And all of the people that you see leaving, there's another one who was just flagged for impropriety with trading. I forgot her name. This just came out a couple of days ago, but she was trading stocks that she shouldn't have been when she shouldn't have been. She's going to be gone too. You're filling these positions with people who I think Trump is hand selecting. And so therefore, what independence? There is no independence. Perhaps Powell is the last piece of pushback, but I think you are beginning to lose independence quite substantially. And as far as what the Fed is doing, I would argue right now something just happened that I think people need to be aware of. Nomi Prince did a great job in writing about it. And something is happening beneath the surface of the financial system, no question about it. And that's the thing that right now I think people need to pay attention to. And it's hard to pay attention because it's not really in your face. The mainstream media doesn't report on any of this. And you're, of all the people I interview with, you are top one or two most well-informed. Now, I don't know if it's because you do so many interviews or because you're like me and read 3-4 hours a day to understand what's happening. But you always have pushback, and the questions you ask me are always well-informed. But you won't find any of this stuff on the mainstream. What I'm getting at is over a 5-day stretch over the last 2 weeks, the Federal Reserve, which has been talking about ending QT and maybe going back to QE and lowering rates, but what they did when no one was looking is they injected $125 billion into the repo market. And they call it in an effort to ease funding stress, right? Which I don't believe, and I'll tell you why in a second. First of all, an injection of that kind of money, $125 billion in a few days, is crisis-like behavior. And it's pretty much on par with what we would have saw when Lehman Brothers collapsed in the great financial crisis in 2018, and almost exactly what we saw during the 2019 repo blowout, where the overnight lending rates went up over 10%. First of all, for people to understand, the repo market is the plumbing of the financial system. It's where banks lend to each other literally overnight. And this keeps everything flowing. Normally, this market is quiet, and that means everything is working. You never hear about it. But when the Fed suddenly steps in with huge amounts of cash, it's the equivalent of hearing a loud banging noise inside your walls whenever you turn the water on. Something isn't flowing right. But what makes all of this really concerning to me, Jay, which is so different than the 2019 issue and the 2008 issue, in both of those issues, they call it a liquidity problem, right? The banks didn't have enough money and they needed liquidity. The Fed had to come in and provide liquidity. And that's exactly what we saw back then. This is not a we're out of money problem right now because the banks have twice the amount of money that they did on their balance sheets in 2008 and again in 2019. They have twice the reserves. So in an environment like this, the Fed rarely, if ever, steps in to inject liquidity because these banks trade with one another overnight. I'm Bank of America. I'll do a repo trade with JP Morgan where I'll take your treasuries. You'll take my treasuries. I'll give you money, or I'll take your treasuries. I'll give you money, and you buy them back the next day. This is to relieve overnight funding stress. And so the banks always trade with one another. But in this environment,
just because you made a great point, a lot of people will have no idea what the repo market is. It's that overnight lending market, bank to bank, because banks have a hard time to forecast deposits and withdrawals on a day-by-day basis. And so at the end of the day, some banks end up with a surplus of cash, some end up with a deficit. They lend that back and forth to balance the books at an overnight interest rate. Is this correct?
Yes, and it should be the most conservative short-term investment or place to park your money on the planet. Liquid, safe, secure, and you're dealing with treasuries, which is a the highest level of capital or collateral you could ever deal with.
Because these loans are backed by treasuries. That's
Correct.
why.
Correct. Right. And so it's just overnight, right? So in this environment where the reserves are this high, the repo injection should be near zero. The banks just have tons of cash. They'll trade with one another.
You're saying they shouldn't need any overnight
None.
lending with their reserves where they're at. Okay.
Well, they could still do the overnight lending because some banks still need it. The banks have enough money to where the repo market should work, and they're trading with hedge funds and other big entities too. Mm-hmm. But the point of it is that when the Fed comes in with that kind of money, like if it was just a moderate level of stress in the market, you'd see 2, 3, 4, 5 billion. If it was a elevated level of market stress, maybe 10, 15, 20 billion that the Fed would put in, 125 billion says this is not about money because the banks are loaded with it relatively comparing to what happened in 2019. It's about trust. The banks are looking at each other and saying, nope, not lending, not even for one night, because I'm not sure you'll be able to pay me back tomorrow morning. And that's because repo stress usually, and this matters because repo stress usually only appears right before market corrections, like in 2019, like in 2008. And history has shown that markets can unravel very fast when you see this environment. This pushes the Fed into emergency action, like we saw in 2019, whether they want to or not. And so in essence, what I would say to you above all is that this is far more than just the Fed coming in and providing liquidity. The liquidity's there. What they're doing is providing liquidity where the banks trust the Fed and not one another. And that's something that's very, very interesting to me, and it portrays, in my opinion, a market that is far more fragile than we are being led to believe.
So the overnight bank-to-bank lending slowed down not because there was a lack of capital or liquidity available from those who had it to those who need it. It was actually a lack of trust in bank stability. And so banks were less inclined to make even a short-term overnight loan to an institution they didn't have the confidence would be as solvent the next morning. And so that's why the overnight lending market dried up. That's when the Fed stepped in with $125 billion. Is this the strategic repo facility? Is that what this is? Is that how that money makes it to the market?
Yes, it is.
Okay. So this is like your buddy that shows up with a bunch of just in case cash, right? But effectively it's created, right? Is that the idea here?
Yeah, we'll make an analogy. All the banks are members of houses on a block, in a cul-de-sac. And everyone borrows sugar from one another all the time. And the cost for doing it, you all work it out. I will borrow you a cup of sugar. You pay me back a cup and a quarter. All right, great, super. Pay back tomorrow. I just didn't have time to run to the store. What it's basically saying is that, no, I got 12 bags of sugar, but Jay, I'm really not borrowing any longer right now because I don't trust him that he'll be able to pay me back. That's what it's like. It's like, if all was moving smoothly, you would trade the sugar, and as it gets more and more stressful, like we saw in 2019, okay, fine. I'll borrow it to you tonight, but you're paying me back 9 cups of sugar tomorrow, okay? So, and it's getting to the point where the rates go higher when the stress or the lack of trust grows higher. And that's where we are right now. And again, you don't hear any of this on the mainstream, but if you read between the lines, when you see twice the amount of liquidity and bank reserves that we had in 08 and 19 and no lending, and the Fed coming in immediately over 5 days and dumping that, and in one day you see over $50 billion of lending going to the window and borrowing it, that tells you that there are people out there that need the liquidity, and the banks who are flush with it, not going to give it. I don't trust it even for overnight that they'll be able to buy it back the next day. That is ominous. That tells you that something is broken within the system, tells you that the big money, the most well-informed money on the planet senses this and is backing away from lending. It's not a good sign, ultimately. It really isn't.
Okay. So that 125 billion, was that over the course of a week?
5
Andy?
days. Yep.
5 days. 5 days. Thank you. was provided to those banks that needed to borrow but couldn't find a partner that would lend because of systemic distrust in the industry.
Exactly.
And that effectively is liquidity creation, right? This is you're treating the symptom, which is a lack of liquidity, but the cause of the lack of liquidity is actually a lack of trust, not a cash shortage. So, okay, what's the? Because just like reading between the lines here, it just seems like a capital injection of 125 billion into the banking system is no different from this or any other quantitative easing program. Is that a fair read, or what?
Absolutely,
Okay.
Absolutely, and it's injecting tremendous. And you look at M2, the money supply, it's going up. They're pumping money into the system, and it doesn't fix the bigger problem. That is the lack of trust, and it doesn't fix the balance sheets. It's a temporary stopgap more than anything, as far as I'm concerned.
Let me ask you, if bank cash reserves are at a healthy level relative to 2019, 2008, what's the cause of the lack of trust bank to bank in the system right now?
Balance sheets, I guess, perhaps. And it's not just the banks lending to one another. It's not some of the ones with the strong balance sheets. It's the banks lending to other institutions, maybe smaller banks, maybe hedge funds. It's not the banks trading with the real strong balance sheets trading back to back with one another. It's the banks lending to the market and to those that use it. And it's not just the big banks that do it, but those are the ones that are saying, nah, I'm not giving up my money. I don't trust that smaller regional bank or that hedge fund will be able to pay me back as promised tomorrow.
Right. Yeah. Has that regional bank done sufficient diligence on the holders of its credit cards and auto loans and
Speaking of auto loans, I mean, they're upside down. And it's the most it's been maybe ever in terms of delinquencies. The same thing with student debt and credit cards. And, this is part of the problem. And I think that's kind of what this is getting at. When you see all of these cracks in the seams, and auto loans are front and center to it, that's exactly why, I think they understand the contagion and the possibility of this spiraling out of control. So they would rather not lend their money out.
Good question. Something I've been trying to understand myself. So, as I see it, Andy, the Treasury's been issuing more short-term bonds than usual in the last couple of years, especially lately, because they can pay a lower amount of interest on that. So it's less of a cost burden for the government. But as a consequence, you have to refill those loans on a higher frequency because, if you're renewing a loan every 10 years, you got 10 years. But obviously not if it's a year or less, 6 months or so. So you're constantly on this refunding treadmill, right? And if the Treasury has got to go back to the market on such a frequent basis to refinance itself, is that also sucking cash out of the system that would normally be available in the repo market? Or are those different activities altogether?
I don't know, to be honest with you. I guess I'd have to think about that one for a moment. It's a fair question, right. But if the Fed is buying bonds from, it is and it isn't. In other words, if the Fed is buying bonds from the banks are the ones that would normally be trading in the repo market, they would have cash. But whether or not they want to lend that cash, for the last several years, the banks have been parking their money in the reserve account at the Fed, earning the federal funds rate, and having no systemic risk. And it's the same thing here. These banks have cash because when the Fed comes calling to buy the bonds from the big banks, the banks sell the bonds, they're obliged to, but they would then in essence have cash. Now, what you do with that cash is another question. And I think to your point, how about we create something called the Genius Act that takes care of that problem, that anytime money moves, it creates a stablecoin, which then buys short-term treasuries, because that is a problem we don't want to deal with anymore. Maybe there is something to that question. I am not exactly sure, but I would think that if they were buying the bond, it's the other way around. If they were selling bonds, well, let me just try and figure this out. I'm pretty sure that the act of buying bonds would actually not pull liquidity out of the system unless the banks take that money and park it back at the Fed, which in essence would be deflationary. It would be pulling liquidity out of the system. But if the banks then take that money and make loans, then you are creating money. It's becoming more inflationary. So it's really after that happens that the banks have to decide, what am I doing with the money? And you can see right here, well, hey, I don't really want to lend it. Maybe I'll just give it back to the Fed and leave it in a reserve account making 4% with safety. And I think that's kind of the issue. Which to your point, would suck money out of the system, yes.
Okay. Do you have any exposure to the Treasury market? Like, are you in long bonds or not at all?
I think anyone who would buy long bonds is out of their flipping mind. I have for the last couple of years had exposure to very, very short-term duration treasuries. And I buy them through Treasury-backed.gov, which you're lending money directly to the Treasury. You are disintermediating the bank. But a 31-day or whatever shutdown of the bank shows you that there is, of the Treasury, of the government, shows you there is risk, even in short-term treasuries. And so yes, but I think any long-term, when you talk about a short-term treasury, which everyone was happy owning over the last couple of years, paying 5% for a 6-month treasury, well, that's great. But when you realize the dollar's down 10 or 11% against the index, 60 or 70% against gold, it's not so great. When we are told inflation's at 3%, but John Williams of ShadowStat says it's 11%, your net real return on a 5% treasury over all that time is really about negative 6% real. And so, yes, I've had some because I feel, well, can I put all my money in precious metals and own a gold and silver company and or mining shares? I mean, I have to have a little diversity, don't I? And I do it begrudgingly. So, yes, I've had some, but anyone who would buy long-term treasury in this environment, I think really needs to take a strong, hard look at the math.
The 31-day government shutdown, did that get your spidey sense going at all? I know now they're saying a lot of economic reports are just not going to be released. It'll be too hard now to get this information out. What's your take on that, Andy?
I mean, I don't know if there's something bigger than we already know in terms of the numbers, but the bottom line is we are broke and we are insolvent. And the reality of it is that our fiscal responsibility has to mean something at some point. When we are creating $1 trillion in 71 days, when we are indebting our future generations the way that we are, look, the world reserve currency since 71, when Nixon closed the gold window, is based upon nothing but trust. And who trusts us anymore with the constant bickering politically? I mean, really bickering. It's disgusting that the partisan fighting, a government that has gone into right, wrong, or indifferent. This isn't a political discussion or a discussion on war. But when we can say to Russia, we're going to kick you out of SWIFT, and we are going to take call it sanction, but we're going to take your $5 billion in U.S. treasuries, and we're going to give that in the form of weapons to the Ukraine, a country you're in the war with. As the world reserve currency, that's a problem. You're not supposed to make those decisions. It's supposed to be for the world opinion, not for the custodian or the issuer of the world reserve currency to be judge, jury, and executioner. And in particular, when you look at the way the rest of the world looks at us, so let me get this right. You guys have been in Iraq for 22 years. You went there under false pretenses. You didn't find the weapons you thought you did. You destroyed their country. You've toppled their regime, and you're still freaking there. And the money that they make in natural resource revenue, you make them hold it at the New York Fed, that you don't even let them control it. So how is that fair? Now, I'm not making a judgment or passing judgment. I'm a patriot, and thank God every day I was born in this country. But what I will say is the rest of the world looks at us as massive hypocrites. And then you talk about President Trump, who just said something yesterday that I find ridiculously stupid, and that is that anyone trades with Russia is going to get a 500% extra tariff. That's not a tariff. That's a sanction. A tariff is put in place to defend your manufacturing, not to sanction you. And when we go around the world as the most fiscally irresponsible country on the planet, that is going around passing judgment, being judge, jury, and executioner, when what we do according to the way they see things is every bit as bad or perhaps even worse. The day of trust, the day of we will take your treasury because we trust you. And unlike the banks who say, yeah, I'm not going to trade with you because you ain't going to get you may not pay me tomorrow. Well, the rest of the world is saying that to us by the divestment of U.S. treasuries and the de-dollarization that you see happening. And I don't care what pushback you get from the milkshake theory or any of that stuff. And I think the milkshake theory is very, very smart and well thought out until it's not. And we're getting to that point where you would expect to see more dollar usage, as we've seen lately, towards the end of a system. In other words, take all the dollars you have and spend them on things. Buy gold, silver, rare earths, buy mining projects, buy farms, buy anything you can with your dollars, spend them while you still can. I think that is what we are seeing right now, but we are no longer trusted by the majority of the planet. We are no longer looked at. We once were the good guys. And I wonder how many people on the planet look at the United States as the good guys any longer, or do they look at it as what the hell's happened to that great country? Look at it under the previous administration, rather, where their actions were far too stupid to be stupid. I mean, what they did with immigration and lawlessness in the cities and you know, the wokeness and the move away from meritocracy and all of this stuff that's, thank God, is kind of passing us. But even still, I think we are not trusted or revered or thought of quite the same way we once were. And if all of we do monetarily is based on trust, Houston, you got a problem. And I think that's what you're seeing.
Great. I love it. Andy, it's always great catching up with you, man.
You too,
I love
brother.
picking your brain, dude. It's fun and I learn a lot. So I appreciate it.
Absolutely, man. Absolutely. And look, I hope I'm wrong on some of this stuff. I just don't think I am on all of it. I think somewhere in between is the truth, but it's not a good thing when you see what's happening with the banks, with the repo market. Just isn't. And I think ultimately you're seeing that in the way that things are happening and the influx of metals into the country. Anyways, it's always good to catch up with you, Jay, and I look very forward to seeing you at your fantastic Vancouver Resource Investment Conference. So only two I go to, yours and the one here in my backyard, Rick Rules in Boca. But I look very much forward to seeing you again and appreciate the invite as always. Appreciate being here and look forward to picking up where we left off real soon.
Good luck, man. Live on stage next time, January 25th and 26th. It's going to be fun. We got like 120 keynote speakers coming this year, Andy.
Wow.
And I mean, like we've been hosting this event for a long time, never in a good market, and
things are changing.
Yeah, it's, it is. And I don't know, just one last question, actually, your take on this, because I watch behavior and sentiment in the gold sector very closely, obviously, and I'm very much in the circle. It's my world, right? The mining equities. And it's been a good market for the last year, right? Last 6 months especially. And I'm seeing a lot of investors sitting on healthy gains and taking profits, and I love it. Simultaneously, as soon as any mainstream media pundit begins talking about our industry or any generalist investor sniffs with interest, it's like the hardened gold investors who've been here for the last 10 years immediately assume, oh, this must be the top. It's getting too frothy, right? We're getting into overbought territory. And the way I interpret this is like, well, it's been so long since we actually had a good gold market that gold investors have so much PTSD, they forgot what a good market actually feels like. Look at the AI market, look at the crypto market, look at the cannabis market in 2017. That's a hot market when everybody and their cab driver is giving you cannabis stock tips, right? We're so far from that in the gold sector, but gold investors are so sensitive to any mainstream attention because they've been contrarians for the last 15 years. They're allergic to it. And they have this funny response, which I'm frankly enjoying. But what's your take right now, just like sentiment in the gold sector, because you see it from a different angle than I do?
Yeah, if Jim Cramer is talking about it, I might get nervous.
Right.
The retail market, when you realize that the mom and pop investor is all in the equity market, largest representation ever, about 55%. They are all in on option purchases, the largest amount of option play ever in the history of the market, and they are all in on margin, the largest margin exposure ever, 1.4 trillion. They are all in. At the same time, you see guys like Buffett sitting on 500 billion in cash. You see Bezos selling 6 or 7 billion worth of Amazon. You see a lot of the people divesting out of Nvidia and moving to cash. Not a good sign. But what gives me what I think, and you don't hear this anywhere, right? Nowhere. You may hear on Fox News, oh, gold, and you see the ticker. Yeah, it's probably the top. No, it's not. Because what you are hearing, if you look closely, is something I've never seen before, ever. 3 examples. Number 1, the chief investment officer of Morgan Stanley says, sell half your bonds and put 20% of your assets in gold. What did he just say? These are the guys that maybe would have said 5% and probably not even. Sell half of your bonds and buy gold. He said it's no longer the 60-40 platform that Wall Street's used for 50 years. 60% stock, 40% bond. No, make it 60-20-20, 20% stock. Michael Hartnett, the chief analyst at Bank of America, his newsletter is a fortune. Thousands and thousands of dollars a year. It goes to the institutional traders. He says, no, 25, 25, 25, 25. So have 25% stock, 25% bond, 25% short-term treasury, 25% gold. And maybe the craziest of all is the bond king, Jeffrey Gundlach. He says a 25% allocation in gold is not overweight. Now, these 3 guys, Chief Investment Officer Michael Hartnett and Gundlach, they're not speaking to the plebes. And the plebes are all of us. They're speaking to the institutional traders up at the top. They're speaking to the people who have brought in hundreds of billions of dollars of metal into COMEX since last November. Billions and billions and billions every month. Who the hell is it? Not a word on who it is. No one knows who it is. I have guesses, but who is it? That's who they're speaking to. So to your point, yeah, Jim Cramer talking about gold, run. CNBC and Fox, take it with a grain of salt. When these guys are talking, it's insane. And I will tell you that the level of business that we have, and we'll do a lot of 700-800 million in sales this year, a lot. That's mostly from much larger orders. Our average order size is getting pretty well near 6 figures. Not always. We work with all size clients, but you're seeing way more and way more 7-figure orders. But we're not seeing the tremendous flow that we saw during Silver Squeeze when everyone put even $1,000 into gold, silver, whatever they could get. 2,000 orders a day. Now it's 200 orders a day, but much, much larger from people who are paying attention. So no, the public is far away. They're all in on equities, on margin, and on leverage. As the insiders, whoever the hell they are the most well-informed traders in the world who are standing for delivery on COMEX and draining the LBMA. They know what's coming. These people don't do things just for the hell of it at that level. They know the inside playbook, if you will. And that to me is what gives me comfort. Not only are the top analysts saying buy gold 20, 25%, what do they really think? But whoever is importing this kind of quantity in gold and silver into COMEX, you have to say to yourself, these people at that level, they know what's going on and they are preemptively preparing when the public is just blissfully whistling Dixie into the stock market on leverage and on margin. What could possibly go wrong? So I think before it's all said and done, maybe this year, maybe next, you'll be standing room only and people will have to fight for tickets like it's the Rolling Stones farewell tour, Let's hope, right?
All right. I love that. Good take. What a strong finish. Appreciate you, Andy. And I look forward to catching you in Vancouver.
You too,
man.
brother. I'll always be there. Thanks for having me. Stay well, Jay. Look forward to seeing you in a couple months.
Okay. Sounds good, brother.
See you, dude.